Welcome to the deep dive, where we really try to cut through the noise for you. Today, we've got a whole stack of sources, financial columns, fund manager surveys, the lot, and we're tackling a question that seems to be on, well, everyone's mind. Is this whole artificial intelligence revolution the opportunity of a lifetime? Or are we maybe looking at, a massive bubble waiting to pop?
It's fascinating, isn't it?
Yeah.
Because you've got the raw technological promise of AI, but it's tangled up with everything else, market trends, how people are investing, even like fundamental questions about what work is worth, what money means. We're going to try and connect some maybe surprising dots for you today, help you see not just what's happening, but why it really matters.
Absolutely. That's the mission, right? Get past the headlines, maybe uncover a few surprising things, and make sure you feel better equipped, really, to understand what these huge shifts mean for you, for your investments. Okay, let's get into it. So our sources, they make it really clear. AI isn't just, some tech buzzword anymore. It seems genuinely poised to, well, drastically change things, how we live, how we work. We're talking potentially disappearing jobs, a completely new take on productivity, business is totally reconfigured. It feels like it's laying the groundwork for a new kind of economy. The potential seems huge.
And that's exactly the core of the dilemma, isn't it? One source puts it perfectly. Is this the chance of the century or an enormous bubble? People are drawing parallels naturally to the dot-com bubble back in the late 90s. You had Nobel laureate Robert Shiller talking about how these viral stories of everything changing just led people to throw money at anything with a website, created a $5 trillion bubble. But the key thing then, and this is important, was that while the market tanked, it didn't spark a full-blown financial crisis. The wider system held.
Right, that historical context is really useful. But what about today? The speed and the scale of AI adoption.
Yeah,
How does that compare? Is it different?
great question. Because today, the pace is, well, it's breathtaking, the investment too. Think about companies like Microsoft, Meta. Over $100 billion spent on AI just last quarter. I mean, that's more than a third of their entire revenue going into AI, mostly for data centers. It's moving much, much faster than I think most people realize. But, and this is a really crucial difference from the dot-com era, it involves leverage, borrowed money. Back then, the bubble was mostly funded with equity, not huge amounts of debt. That limited the systemic fallout. Today, we're seeing default warnings starting to pile up in private credit markets. That's a huge $1.7 trillion market, and it's getting concentrated with weaker borrowers. And importantly, these private credit funds, they're leaning much more heavily on bank loans now. It jumped from 1% of bank loans back in 2013 to 14% today. So if this AI wave leads to a bubble that pops, the borrowed money aspect means it could potentially drag the whole financial system down with it in a way the dot-com bust didn't.
Wow, okay. That leverage point really changes the potential risk, doesn't it? And thinking about the internet, its real deep impact took way longer than people first thought, like 10, 15, 20 years even. So for you listening, the question becomes, could AI be similar? Could we see a big market correction, maybe a lot of air coming out before we see the real long-term payoff? And crucially, how does that possibility affect how you think about your investments right now? Okay, let's shift a bit. What's the general feeling in the market? Sentiment-wise, we looked at these fund manager surveys, and it's really divided. On one side, you've got 55% saying they already see productivity gains from AI, so it's not just future talk, it's happening now. But then the bubble believers are growing. 41% now think AI stocks are in a bubble, up from 37% just the month before. And a pretty significant chunk, 14%, actually name the AI equity bubble as the biggest risk out there, right up there with inflation, trade wars, interest rates.
Which brings us to this really important point about market structure. What's happening at the top? The sources talk about an unprecedented dominance of mega caps. It's quite stark. The top 10% of U.S. stocks by market cap, they now account for 76% of the total market value. 76%. That's a record. Higher than the Great Depression, higher than the dot-com peak. Put simply, just 10 companies, your Apples, Amazons, Microsofts, Nvidias, Alphabets, Metas, Teslas, make up 40% of the entire S&P 500 index.
40%. That's not really diversification, is it? If you hold a broad S&P 500 tracker fund, you might feel safe, diversified, but actually almost half your money is riding on the fortunes of just these 10 giants. That feels like a massive concentration risk. What if just one of them stumbles? Regulations change, recession hits, the AI hype cools off.
Exactly. The ripple effect could be huge. And it's not just the concentration. Market valuations overall, they look really stretched. Things like the Shiller KP ratio, the PE ratios, they show the S&P 500 as historically extremely expensive. We're talking, what, 3 standard deviations above the long-term average for the Shiller KP? That's rare territory. It means investors are paying a very, very high price for expected future earnings, a price level that often hasn't ended well historically.
Okay, and here's something else we dug up from the sources, maybe a big red flag. The crazy rise of stocks in companies that aren't actually making any profit. There's this index, the Goldman Sachs Non-Profitable Tech Index. It surged 66% since April. 66%. That blows the S&P 500's 31% gain out of the water over the same time. Doesn't that scream risk on? Like people are just chasing anything that moves, fueled by maybe FOMO and easy money rather than actual business value?
It certainly looks that way. I mean, in a really healthy bull run, you usually see profitable, solid companies leading the charge. When the loss makers are the ones flying highest, that's often a classic sign of, well, market euphoria, frothiness. It suggests buying might be driven more by that fear of missing out, that FOMO you mentioned, rather than a cold, hard look at the fundamentals. And historically, this kind of action often lines up with expectations of easier monetary policy, cheaper money coming down the line. So for you listening, it's probably a good time to ask yourself, does my own approach lean towards chasing these fast, maybe speculative gains? Or is it grounded in fundamentals, in value? Am I buying because I see real value or just because I'm scared of missing the boat?
Right. Okay, let's widen the lens again. The bigger economic picture, the macro outlook, the fund managers we looked at. The consensus overwhelmingly is stagflation, 70% expected. So that's sluggish growth, below
Yeah.
trend, but inflation staying stubbornly high, above trend. That's a tough mix.
And it raises that big question. What does the Fed do? The central banks generally, but especially the Fed. Inflation's been sticky, higher than they wanted, sure, but they've also got that other mandate, maximal employment. And recent U.S. job creation numbers have been, well, pretty weak, falling way short of what's needed just to keep up with population growth. We're talking like 12,000, 14,000 jobs created when you probably need 70,000 to 100,000 just to stand still. So that could really pressure the Fed to think about cutting rates, even if inflation isn't fully tamed, just to support the job market.
It's a real balancing act. So given all that complexity, where are the big money managers putting their cash? Where are they shifting? And what can we learn from that? Our sources show some interesting moves into alternative assets.
Yeah, definitely. Gold, for example, still seen as that classic safe haven. Nearly half, 48% of fund managers are invested. They hold about 4.1% of their assets in it on average. And what's interesting is fewer of them think it's overvalued now, only 11%, down from 26% last month. So maybe it's looking more attractive to accumulate at these levels from their perspective. Crypto, though, Bitcoin specifically, it's a completely different story institutionally. The allocation is still described as marginal, tiny. Only 9% of managers are in, and it's just 50.3% of total assets under management. That's, what, 7 times less than gold. So while institutions still mostly see it as speculative, you don't have that widespread institutional euphoria you see in AI stocks, for instance. And some sources point to its behavior becoming more, let's say, mature. Volatility dropping, maybe moving into an institutional cycle rather than just retail hype. One source even did the math. If Bitcoin reached gold's market cap, you'd be looking at maybe $800,000 per Bitcoin. Now, that's a big if, of course, but it highlights the potential some see. And then there's another pocket of the market showing real divergence.
Small cap stocks. Bets against small caps. Bearish bets are at their highest since the 2008 crisis. There's this enormous gap between how mega caps like Nvidia are doing and how the Russell 2000 index of small companies is performing. It's huge, which sets up this kind of fascinating question. Is big tech massively overvalued, or are small caps just incredibly undervalued? Or maybe a bit of both. If, and it's another if, interest rates do eventually come down and liquidity improves, you can see what's called a short squeeze in those small caps, where the price starts moving up, forcing the short sellers to buy back shares, pushing the price up even faster, could lead to some sharp gains there.
So again, for you listening, it comes back to diversification, doesn't it? Real diversification. Are you all in on those potentially stretched mega caps? Or are you looking at these other areas where maybe institutional money is playing defense, like gold, or where they see perhaps huge untapped upside, like potentially crypto or small caps down the line, balancing that risk? Now, as people try to figure out where to put their money, there's another trend emerging from our sources. And this one feels, well, a bit different, maybe unsettling for some. It's about investment flowing into sectors like defense. Our sources show Dutch households, for example, have really increased their investments in defense companies, around 800 million now. And the EU's own investment bank, they're planning to put 1 billion into the European defense industry this year alone.
Yeah, and that definitely brings up some difficult questions, doesn't it? One source we looked at presented this really stark calculation. They said, look, if you took just 10–12% of the global defense budget that's currently $2.4 trillion a year claimed, and you save that money, essentially money not spent on explosive, you could end world hunger or provide free health care for everyone on the planet. Yet the money keeps pouring into defense. Why? Because, as the source put it very bluntly, money makes the world go round in that sector. Geopolitical tensions, government spending needs. It creates demand. And investors see potentially reliable returns, especially in uncertain times.
The source called it shocking, actually, suggesting maybe households are investing without fully thinking through the wider implications. And they made a plea, really, to focus more on investments that are both profitable and peaceful, investments that foster peace and human appreciation rather than conflict. It's a call to think about aligning investments with values, perhaps looking for opportunities that build a different kind of future.
And you can kind of see how Europe's broader economic struggles might feed into this, too. Europe's facing some serious headwinds. Places like the Netherlands, Germany, their industrial production is declining. Part of that is losing cheap Russian gas, so energy prices are up, making things more expensive to produce. Then you've got trade issues impacting exports to the U.S. and China down over 10%. And on top of that, burdensome EU regulations, high import tariffs. It makes Europe, frankly, less attractive for businesses. We're even seeing some companies apparently moving operations to places like Dubai, chasing lower taxes and less red tape. It's a tough climate.
And speaking of Europe scrambling, there's this fascinating bit about digital currency. Europe seems to be fast-tracking plans for a digital euro, but the sources suggest it's kind of out of fear or panic. They seem worried that new U.S. rules on stablecoins will just cement the dollar's dominance even further, worried that euro deposits might effectively shift to the U.S., making the dollar even stronger in global payments.
It's quite ironic, really. It shows the power dynamics at play. The European Central Bank, the ECB, initially wanted a very controlled, probably private, digital euro. Now, they're apparently even considering a public blockchain. That's a huge shift, driven by competition. As one source dryly noted, nobody ever cried on the streets because the digital euro didn't exist. End quote load. It really highlights that core truth. Money is power. A weaker euro means less power for the EU. And this whole situation, this political maneuvering around currency, it just underlines why some people are looking to assets like Bitcoin or gold as a way to maybe place their financial future outside the direct control of these political games, whether it's perceived laggards in Europe or pioneers in the U.S.
So if we try and pull all these threads together, AI, market structure, alternative assets, ethics, geopolitics, currency wars, what's the big takeaway? Our sources seem to suggest that AI could change things so fundamentally, productivity, automation of labor, that the very definition of money, how we get paid for our time, it's all genuinely up in the air. We really are moving into uncharted territory, aren't we? Where the old rules about work and value might just not apply anymore. Wow. Okay, that was quite the deep dive. From the massive potential and risks of AI to the crazy concentration in markets, the search for value in places like gold, crypto, small caps, and these really profound ethical questions around investment choices, it really shows how interconnected everything is. Tech, money, politics, values.
Absolutely. These shifts we've talked about today, tech, geopolitical, financial familia, they aren't just abstract headlines. They feel like fundamental changes. Changes that are actually redefining how we think about value, about work, about money itself here in the 21st century. It's about looking beneath the surface noise to understand the deeper currents shaping what's next.
So here's something to maybe chew on as you reflect on all this, a final thought. In a world where AI is fundamentally changing work and wealth, where markets are more concentrated than ever, where governments are battling over the future of digital money, how will you position your assets? Not just to build your own financial future, but maybe also to align with your values, to contribute in some way to the kind of world you actually want to live in.